All right, so good morning, and I trust you are all doing well. So we continue with our series on financial accounting 2. This will be lecture 3, and we will be looking at partnership accounting. Partnership account or partnership account. All right, so what we're going to do is that we're going to take some theoretical aspects and understand the theory. Then we'll move into how we do the computation and the presentation of the financial statement. So let's start with the definition of a partnership. Partnership, the definition. All right. Now, when we look at partnership, unlike the sole proprietor who is doing a business by him or herself, this one, 2 or 3 people or more people will come together and they now come in place to form one business venture. And the purpose of that same business venture is to what? Make profit. Now, if any business is established without the purpose of making profit, then it becomes a not-for-profit making organization. All right, so we will tackle it under that. But so far as the business is in the purpose of making profit, then we can fix it into either a sole proprietor, either a partnership, or a company that is limited by shares. All right. So that is how we group it. Now, what is a partnership? When you talk about a partnership, we are referring to 2 or more people. So partnership is the association of 2 or more individuals, all right, that carry business or carrying on a business venture for the purpose of making profit. All right. So here in there, you see that it's an association of 2 or more people. All right. So that is the first thing that you see there. 2 or more individuals. They carry out a business venture. All right. And the purpose is what? Profit making. Now, this partnership is regulated by law. So if you look at our Private Partnership Incorporated Act in 1962 Act 152, what it tells us is that this section, in fact, you look at the section, it tells us that this 2 is the minimum you will need to form a partnership. So without that number of 2, you cannot have a partnership. And the law actually defines the more. More means that it should be limited to 20 individuals. So the maximum number of partnership you can get is 20 individuals. All right, so that is that. Then when you look at this aspect that talks about forming a business venture, you realize that they are forming a business that is identified separately. So you see this one, they will have a corporate entity, or let's say they will have a firm. They will have a business, a firm. All right, they will have a firm. All right. Then herein, we see that they have to be making profit. And because they have to be making profit, we need to start thinking about our income statement. And we need to start thinking also about what our balance sheet. Because any company that does that, we need to go in there and prepare financial statements for that. So basically, that is the outlook of a partnership, and that is what we are going to do. Now we're going to go on to the next step and try to actually expand this more, looking at what then is the nature of a partnership. What do we see to be able to say this form of business venture is a partnership? What do we see to do that? So what is the nature of a partnership? So first of all, what you see in here is that you see it is an association. It's an association. Now, this association has a minimum number of how many? Yes, your guess is as good as mine. You have 2. All right. Then what is the maximum number? Yes, we have what? 20. 2 to 20. So that is how that describes how a partnership is. So if you go beyond 20, then probably you are looking at a company. All right. So basically that is that. Now the thing is that you also see here is that the purpose is for profit. So it's formed for what? Profit. It's formed for profit. So therefore, if it is not formed for profit, then we are looking at what? And not for profit making what? Entity. Now, another thing you need to look at is in here is that this is a partnership. And so in a partnership, what you see here is that the individuals of the partnership are very liable to the liabilities of the partnership. So the individuals in here, who we call the association of 2 or more people, those 2 or more people are actually called what? Partners. All right. So what you see here is that when it comes to a partnership, the partners, the individual partners, so each individual partner are liable, all right, to their share of debt. Partners are liable to their share of any debt. So what you see in here is that because it is a partner, what you see there is that before it is a partnership, because the partnership that is run by individual, the individuals are severally and jointly liable to the debts of the partnership. But you see, a partner is not a partnership. The partnership is the entity. Take note of that. The partnership is the entity that they form. All right. But the partners are what? The individuals. So when we say that these individuals are liable for their share of debt in the partnership, all right, the debts of the partnership or debts that the partnership cannot pay, all right, so we are looking at the debts, the liabilities that the partnership cannot pay. So the individuals therefore become liable for that. And that is a little bit of danger when it comes to partnership. All right. So that is that. So this means that the partners could be forced to actually settle or sell their own private properties to be able to settle the partnership's debts. All right. So that is that. So that is what you see in here. But it must be said that even though that is done, what you can also see about it is that the partners are actually not the partnership. And so kind of the partners are distinct from the partnership on the face value. But if there is anything that goes beyond settling debt of the partnership, the individual partners have to take responsibility of that. But on the face of it, the partners are distinct. From the partners. So in Ghana, our tax laws taxes the partnership separately from the partners. All right. So, I mean, there is a special treatment. We look at it here also in terms of appropriation. All right. We share the profit. Also, that is another thing you need to also embrace about a partnership. Profit and losses are actually what? Shared. All right. So take note of that. Take note of that. Now, sometimes elsewhere, even though we have partners who have the partnership has unlimited liability, elsewhere people have started limiting the liabilities of a partner so that in case there is debt, it will be limited to how much they contribute as capital. All right, there is the upfronting of the coming of what we call limited partnership. All right. So those that have their liabilities limited to how much they contribute. So that one, if I contribute 10,000 and they arise a liability, you can only use my 10,000. You can't come to me. I will not be able to sell my private property, or I will not be liable to sell my private property to actually settle the debt. So that is what you have in there. But generally, we say the partnership are unlimited. So those ones that have the partnership being unlimited, for that, what you see in there is that the general partners, all right, there's a general partners, and those partners are those who have their liabilities what unlimited. We will take a short look at some kinds of partners. All right, we'll take a short look at that. So we know that from here, we know that what we see here, liabilities of the partnership are what? Unlimited. All right, the liabilities of the partnership are unlimited. So we talk about unlimited what? Liabilities of partners. And those who have these unlimited liabilities are called general partners. General partners. So if you are asked to explain who a general partner is, you have to understand the concept of. Yes, of course, partnership are unlimited, but like I said, these days there is a coming of what? Limited partnership. And most important aspect, and that I'm going to use in red ink, is that every partnership is mostly regulated by an agreement. So therefore, partnership are regulated what? By what? Partnership agreement. They are regulated by partnership agreement. So take note of that. Take note of that. There is always a PA for a partnership, and the law gives provision where the partnership did not make a PA. All right. So this is what we have in here. So this is the nature of what? Partnership. But like I said, these days there is the coming of what? Limited partners. There's the coming of limited partners. All right. So for limited partners, what you see here is that they are liable up to how much they contribute as capital. So let me just talk a little about that. So we're talking about limited partners. And what you see in there is that when you talk about limited partners, what you can see in there, you see that their liabilities are limited. All right, liabilities are limited to how much capital they put in. All right, so for that one, it means that you can't go beyond how much capital they put in. All right, you can't go beyond that. Now, another thing you see about these limited liability, the limited liability partners, are that they are not allowed to take management position. They are not allowed to take management position. All right. So unless they become what? Unlimited. They are not allowed to take management position unless they are unlimited. So unless you become a general partner, you can't take up management position. All right. So that is that. But in a partnership, you must understand that not all partners can be limited partners. There has to be some that are unlimited. All right. So all partners cannot be what? A limited. All partners cannot be limited partners. There has to definitely be some who will be unlimited. All right. Then lastly, what I can add to you is that they are not allowed to take back their contribution towards the partnership. All right. So like the way in the general partnership, you be allowed some drawings, from your capital. No, this one, you are not allowed to take back some contribution. From the partners. So these are some theoretical bits that you need to grab, right? Very important to boost your understanding about what a partnership or the nature of a partnership. All right. So briefly, I just want to introduce you to some kind of partners. All right. There are some kind of partners. It's very good you have a glimpse of them. And I mean, it's very, very important because as part of business management and other stuff, you'll be asked to, explain. But for now, let's get the theory understood. All right. So there is the general partner as I've mentioned. All right. There's a general partner as I've mentioned, but there is also the limited partner. So the kinds of partnership. So understand what a general partner, kinds of partners, sorry. Understand who a general partner is. So the one that has unlimited liability, all right. Then understand who what we call a limited partner is. So this one has his liability limited to how much he puts in as capital, all right. Then understand who an active partner is. So the active partner is actually the one who takes part in the business administration. So that one, when you go to the office of the partnership, he is there actually doing the work. All right. Then we have what we call the dormant or the sleeping partner. That one has capital in the business, but they are not actively involved. All right. So the opposite of active is what? Dormant or sleeping partner. He has contributed capital, all right, but he is not actually engaged into the day-to-day administration of the company, all right. Now, then we have another one called quasi partner, the quasi partner. Now, a quasi partner also kind of have some capital left, all right, inside the business, but it is usually left in there as loan. All right, it is left in that. No, he's actually a retired partner who is actually not doing an active participatory, all right, activity. And his money that is left into the partnership is a loan, not actually a capital. So his capital is left into the business as a loan. And those people normally front the partnership. They use their name to give the partnership some brand. All right, they don't leave. All right, they use their name to give the partnership some brand so that people will know that they are part of the partnership, because probably when they know, they will actually do business with them. So that is what you have in there. They are called quasi partners. All right, quasi partners. Now, what I'm going to do next is to delve into this partnership agreement, the PA partnership agreement, because every partnership is regulated by what? The partnership agreement. So let's go into it and understand more of the partnership agreement. Partnership agreement. Another name for this partnership agreement is actually called the partnership what? Deed. The partnership deed. All right. The partnership deed. Now, this is just a document. Now, it's a document that details the relationship, how we govern the partnership. All right. So it expresses the terms and conditions under which the partnership is supposed to operate. So it's just a document. So it's like an agreement that is being written. So the PA, partnership agreement, is a document. So a written document that actually stipulates, it tells us, all right, how the relationship, so it stipulates the terms and conditions, all right, under which the partnership or the partners are supposed to behave, or under which the partnership must operate, all right? So the terms and conditions under which the partnership and or the partners operate. All right, so that is what you have in there. This is the underlying document that establishes the relationship between the partners. So it tells us the relationship within the partnership, and also expresses the terms and conditions under which the partner or the partnership must operate. Now, inside that document includes certain things we must grab. So inside that document, we have things like the name of the partnership. So the name of the partnership. Also in there, what we have here is the capital contribution of partners. Capital contribution of partners. How much each capital is supposed to contribute, all right? Then again, we have the profit or loss sharing ratio. Profit or loss sharing ratio. When we get profit or when we get loss, how are we going to distribute it? It also has the rate of interest. Rate of interest on drawings, any drawings that will be made. All right. It also has the interest on drawings, on loan, on even what? Non-even capital. All right. So if you make some capital contribution, maybe an excess of it, or maybe the agreed one, you get some interest. They are all established inside the partnership agreement. Now, again, what you see here is also salaries paid to partners. To be paid to partners. All right, whether paid or not, accounting is on accrual basis. So if you have to pay and you've not paid, it's there. You have already paid to, it is there. Then we have dispute resolution procedures. If there is any argument, how are they going to settle it? So that one too is also established in there. Then there are methods of valuing assets, especially the intangible ones, methods of valuing or valuation of assets. All right. So you need to get that into the partnership agreement, and even how they admit new members. How to admit new members. If new members are coming into the partnership, right? If there is a new partner coming in, how do they agree for the person to come in? So these are some of the things you see in the PA, but notable among them is this one, their capital contribution, profit or loss sharing ratio, then these interest and these salaries. Never forget those ones. But what if there is no partnership agreement? Now, so in case there is no partnership agreement, all right, in the absence of partnership agreement, so where there is no partnership agreement, certain things are stipulated by the law, which you must understand. The Act 152, where there is no partnership deed or agreement, certain things are meant to be understood. And this is where I tell students that memorize it. Memorize it. So try and remember these things. Now, if there is no partnership agreement in the question, then it means that the profit or loss are shared equally. Again, it means that there is no interest on capital. There will be no interest on capital. Not only capital, but on loan and even on drawings. All right, so take note of that. There will be no interest on such. Again, capital contribution will be equal. All right, capital contribution will be equal. So these are what happens. So you realize that each partner will have to contribute equal capital. So we have equal capital contribution. All right, so that is very, very important. That is very, very important. Again, because of that, no partner will be allowed to take salary. So there will be no salary. There will be no salaries to partners. Understand that salary to partners is not the same as salaries to employees. Please understand that. All right. We are looking at here in things that are interesting to the partnership. So now, what will happen is that every partner will be entitled to be part of the management of the partnership. You will be entitled to the management of the partnership. So everybody will be doing something inside the partnership. All right, so take note of that. All right, so these are things you need to really understand when it comes to the partnership. Of course, there are some advantages and disadvantages of a partnership. Who can tell me? Yeah, your guess is as good as mine. So when we look at certain advantages, this will be the last thing we do. Then we go into the accounting for partnership. So advantages. Is it good to have a partnership? Yes, it is good. Why? Because when you do partnership, you spread your risk because the profit or loss are shared. They are shared. So it means if there is a loss, you are not the only one going to bear it. You will share. So that is one advantage this one has over a sole proprietor. Because in a sole proprietor, if you have a loss, it is on you alone. All right. So that is that. Number two, you look at skill development. Skill development. You see, a partnership is not a jack of all trade because people come together, each person brings his skill. All right. So you learn from one another. But when it's a sole proprietor, it is you alone. You alone. So sole proprietor is a jack of all trade. Now, partnership pool resources. So talk about resource pooling. You want money, capital, you are only one as a sole proprietor, you can't raise much. But when 2 people or 3 people or 20 people come together, they can actually raise money. But the disadvantage and the similarity of partnership to a sole proprietor is that both of them, we have unlimited liability. Unlimited liabilities. And because there are 2 or more people in there will always be disputes for you to settle. And the fact that there is dispute tells you that there is slow decision-making process. If I'm only one individual, can decide and move. But because we are partners, I need to consult one or the other, and that can slow the decision-making process. Now let's go to the big deal, which is the income statement preparation. The income statement preparation. So I'm going to give you the format, and in a part 2 of this video, we will look at questions. All right, we will be looking at the questions. All right, so let's go into the accounting for partnership, the accounting side. That is what you've been waiting for, right? So accounting for partnership. All right, now the same thing happens, because remember we said the partnership is an entity, and if it is an entity, then number one, what is going to happen is that they are going to prepare income statement. All right, so they are going to prepare an income statement. Now be careful, because the partnership's entity can be a manufacturing entity. So everything we learned under manufacturing accounting can be applicable. So the separate entity the partnership has formed can be a trading, all right, trading company where we have to prepare a trading income statement. It can also be what? A manufacturing partnership account. So it can be any of them. So there is the preparation of one, the income statement. The income statement. So now when you prepare the income statement, you are going to share, you get a net profit or loss. You are going to share the profit, all right, or the loss. You are going to share it. But before you do the sharing of the profit and loss, somebody might have been working as a partner in the partnership. You need to pay him a salary. Somebody who might have taken some drawings from them. I mean, kind of taking something from capital. The partnership entity will be taking interest. So we have to add back those interests to the profit. All right. And some too maybe doing some an extra capital or current account that they will do. And if the current account is a credit and they are supposed to be taking interest as partners, we have to deduct all those things. If the current account is debit, is as good as you drew money from them, and therefore you are supposed to also pay interest to them. So in that case, you will add it. So you make those adjustments before you share the profit. And those adjustments are done in what we call the profit loss appropriation account. Appropriation simply means you are sharing. All right. Appropriation account. So appropriation account is simply an account that shows how the profit for the year is going to be shared among the partners. All right. So that is that. The appropriation account shows how much, all right, or it shows how, or it gives how detailed the profit or loss are shared. All right. So how the P&L is shared. So it provides the detail for how the profit or loss is shared. All right. So I'll give you already, we know how to prepare an income statement. So you have your sales, less cost of sales, then you have operating expenses. If you get your gross profit and there's any other income you need to add, you add. All right. So then you take off your expenses, then you are good to go. Then you come and prepare an appropriation account. How do we then prepare this appropriation account? So let's take the format, okay? So the format of an appropriation account. All right. So inside the format of an appropriation account, so if you know the names of the partners, so put the name of partnership, of the partnership. So you put the name there. Then what you go in there and do is you prepare your profit, loss, appropriation account. the year ended. So you put it there, then you underline it nicely. All right, you underline it very nicely. So you put in your currency. Put in your currency. Now, once you dealt with your currency, now let's start the build up. So you will start with the net profits that you had from the income statement that you prepared, the net profit that you had. So you do net profit brought down. All right, then you put it in there. All right, so take note of that. Now, sometimes you have to be very careful. Sometimes in questions, the net profit will be given to you already. But if it is given to you already and you are not the one who prepared, first of all, you are asked to prepare. But if in some questions you are not asked to prepare and it is given to you already, then you have to be careful to make some necessary adjustments to the net profit. So let me just put in the adjustment that you need to make. But please, you do the adjustment only when you are not the one who prepared the income statement. It has been given to you already in the question. But if you are the one who prepared your income statement, you do all the adjustment that is supposed to be done in the income statement before you can get the net profit that you brought here. So be careful in the two scenarios. We have one scenario in the question where the net profit has already been given to you. You didn't calculate it. It has been given to you. In that case, look out for all the adjustments that you have to make. All right. But if you are the one that prepared it, it means that before you ended up getting your net profit, you had factored in all the adjustment that was what needed. So you will need to repeat the adjustment again. So in case the question that you are solving already has the net profit given to you in the trial balance, then you have to do some adjustment. And the adjustment too, it depends on the question. Some questions you may not be doing any adjustment. All right. What you need to do in there is that, you see, if there is any drawings of goods, and I repeat, drawings on goods. So we are talking about adding, all right, goods taken, cost of goods taken. So if they took in goods, then you have to add back. Now, why are we adding this? Let me show you something. You know that in your study for accounting for a sole trader, you would have normally done sales, right? So let's say instead of using X, let's say our sale is, let's say tentatively, let's say 1,000. All right, we have sales of 1,000. Normally what you do is that you do less what? Cost of sales. How do you do cost of sales? You do opening stock, right? So opening stock, add what? Purchases. Now, this one, let's say it is 500. You have purchases to 200. All right, you have purchases to 200. If there is any carriages, you know that you add carriage inwards. So let's say that one is 100. Now, total, you have what? 800. Now, if there were drawings of goods in your footnotes, what you do is that you less drawings, don't you? Less drawings of goods. Let's say the drawings of goods is 500. This is what you would have done. So you get something like what? 300, right? Then this one is called cost of goods available for sale. Then you less closing stock. Let's say our closing stock is just 100. So it means we will have what? 200. And our profit will be what? 800. This is what we do. But assuming that you have been, so this one you less expenses. So let's say our expenses is like 500, which means our net profit is what? 300, right? So net profit. So what do we do? What you see in here is that you have your net profit, and that is what you brought here. That is what you bring here. All right. But let's assume that the entity in your footnote, you've been told that there were drawings of goods in your footnote, additional information. And that drawings of goods were not captured in here. So this 500 will not be done. So it means that this 500 was never done. If this 500 wasn't done, it means that our cost of goods available for sale would have been 800, right? Should have been 800. All right. Should have been 800. And our closing stock would be 100. Therefore, our cost of sales would have been what? 700. And if our cost of sale was 700, it means our profit would have been what? 300. All right. And if our profit was 300 and we are deducting expenses of 500, it means we have a loss of what? A loss of 200. So that is when the drawings were not captured. So it means that the loss of 200 would have been what? Our net loss to be taken to the appropriation account. So if in the footnote you are told that they did drawings, and if you are bringing the drawings back, what do you think we should do? Subtract or deduct? Or add, sorry, subtract or add. What you see we did for us to do is that for us to get the proper profit, you realize that we need to add the 500, and when we add the 500, our profit will be restored to what? 300. So that is why when you come here, you need to add any cost of goods taken and add to your net profit brought down. All right, so don't forget that. Don't forget that. All right. So once you do that, you can get your new figure. And another adjustment probably you may be doing to help get your adjusted net profit is to less certain things like interest on loan. Interest on loan. Interest on loan. Because the interest on loan is a P&L item. So you know in your sole proprietorship account that interest on loan we take off. So if it wasn't done, we would do it. So it's something we are subtracting. Not only that, we have expenses, general expenses. So we are talking about P&L expenses made by partners on behalf of the partnership. So if there is any expenses that the individual partners have made on behalf of the partnership, then it means that that money they spent should have been spent by the partnership, but they did it. So it means that the partnership owed them that money back. All right. But it's an expense they did for the partnership. So you have to subtract all these. Then when we do that, we now get what we call our adjusted net profit. Adjusted net profit. Like I've told you, you may need to do this because the net profit was given to you in the question. Sometimes you will be asked to do the income statement. It means that when you are doing the income statement, you will do all these things inside. All right. So that is that. So we continue.